We are also following the market reaction to hints, I stress hints, that the Chinese might be willing to budge a little bit on some of the demands from President Trump, including opening up their auto market to American auto manufacturers. Now, right now, the Chinese imposed a 25% tariff on American cars sold there. Some very expensive ones actually have a higher tariff. Be that as it may, Xi Jinping, the leader there overnight, hinting that they might be able to move on that and intellectual property issues and the like. Too soon to tell. What we do know is that this has had an indirect effect in the commodities arena, where some of the agricultural items like soybeans and corn and wheat and cotton were in the crosshairs of the Chinese as a response to what the administration was doing. Now, originally, a lot of those items were going down in price on the belief that China was closing itself off as a market for these items. Less so now. The CME is where a lot of that stuff is traded, and doesn't its CEO, Terry Duffy, know it? He joins us now. Very good to have you, Terry. Welcome.
Thank you, Neil. Appreciate being here.
I get a sense, and it's just reading the markets and the trading going on by you, that it's calming down a little bit, or at least the concern is calming down. What would you say?
Well, I think it is to some extent, but it seems to be changing by the day, Neil. I mean, we've seen such extreme volatility in the marketplace. So you look at the overall equity markets, you talk about it all the time. We see 300 down, 300 up. Today, the market seems to be reacting quite positively to President Xi's comments about what you were just referencing. So, let's see if it's sustainable. And we've heard this type of comments coming out of China before, whether it's on intellectual property or other products. But one of the things that I think here for the American producers of food is a very big deal, because that is one of our #1 export products that we have here. As you know, we have plentiful supply of food here in the United States. We are a big exporter. Our farmers are very proficient in their yields and what they can produce, but it's a global market and they need to export this product. So any kind of tariffs in their margins get squeezed dramatically on the family farmer, which we don't need any more pressure on the family farmer today.
Yeah, there were a lot of people who were saying when these prices were going down for a while that American consumers would benefit, and I was talking to a pig farmer who was saying, yeah, as long as I'm in business, but it could drive me out of business. Those threats were very, very real. Who's been driven to tread on these? I would imagine, much like stocks that are in the news, you get some newcomers who trade crazily in this environment.
Well, I don't know if they trade any differently, Neil, other than it becomes on people's radars, because it has a big influence on our economy. Our agricultural sector is a big part of the U.S. economy. It could have adverse effects on other parts of businesses. You got to remember there's a lending component to everything we do here in the United States, including agricultural products. So more and more people need to pay attention to the prices of these products. So when you look at the pork market, you just referenced it, it went down exponentially over the last several weeks when these were announced. There's people that have loans against some of the production of their pigs, and then you have the grain producers. They have loans against their yields. So there's a big components associated with just not ag, but in finance associated with these products.
Yeah, and again, they seem to almost return, not across the board, but almost return to where they were before this whole hullabaloo started. Yep. But it has changed people's views of these type of commodities, these types of investments. A lot of people don't find investing in corn or soybeans or wheat or pork belly sexy, but it is quite the growing market mechanism. And I'm wondering if, because of this rift with China, it's not all over yet, that has forever changed. That people are now looking at commodities in a way they never did before.
Neil, that's an excellent point, and I will tell you that just the other day, it was about a week or so ago, we traded over 3 million agricultural products. Now, to put that in perspective, 15 years ago, the average daily volume in total here at the CME was about 2 million contracts. So the smallest sector of the CME group, which is our ag sector, traded 3 million contracts, a record level of participants back in the marketplace. People are very concerned about this asset class, as well they should be.
On interest rates and rates going up, I've always been curious, Terry, whether there's a correlation to what happens on your trading floor. Now, I know you go way beyond just these particular commodities. I could get into gold, I could get into energy contracts and all the like, but that we are living in a rising rate environment. How has that changed things for you guys?
Well, the biggest change, Neil, I would say is, you know this as well as your viewers do, is that the Fed, or our central bank, has announced that they're going to take down their balance sheet, which means they're not going to be accumulating as much debt. Well, in return, that means someone has to do it. We're running at record debt levels. We need to issue bonds and treasuries constantly. So if the Fed is going to not participate like they once did, then other participants need to pick up that slack. And what's interesting about that, Neil, is we have the only Federal Reserve that does not hedge their portfolio. So the people that are participating in buying the U.S. debt, they do need to hedge it. They don't have the same ability like the U.S. government by leaving it unhedged. So that will continue to add participation into the interest rate market here at CME Group.
Well, we're going to need someone to do it. We're looking at $1 trillion deficits apparently soon, so someone's going to have to find a way. You know, you also trade these Bitcoin futures. How are they doing?
You know what? Steady as it goes, Neil. You know, I was on the mindset when we came out with Bitcoin, you know, we put a lot of different controls that we would not put on other products. I want to be very cautious about this. I was very concerned that it was a potential bubble, not on the pricing, but I didn't want people to get caught up in the euphoria of the Bitcoin. I wanted the professionals to come in here and participate in the marketplace. So we made margins extremely high. We made limits very tight. And I think it served us well. As you know, we launched Bitcoin at $19,500 a Bitcoin, and now it's trading around $6,600. So if you would have brought in the participants into our marketplace, they could have got hurt dramatically. The professionals have been in here. You know, we had 47% margin that we were holding for Bitcoin when we listed it. We're still holding 47% margin.
Is that
so the
right?
pays and collects have gone very well. Yeah, we're still holding the same amount of margin that we were holding, even though the price has gone down more than half. So I think we've done a very prudent thing here. Now, we're not knocking it out of the park as far as volumes go, Neil, but that's okay. This is a new asset class potentially, and I want to make sure we walk before we run here.
No, I think it's a wise strategy. I know you also want to be an adult about it, providing a mechanism.
Absolutely.
And not a crazy bubble here. Really good stuff. Thank you, Terry, for taking the time. I appreciate it.
Thank you, Neil. Appreciate it.